There's something happening in the global economy right now that hasn't occurred since the 1940s. It's not a stock market crash. It's not a housing bubble. It's something much bigger, much slower, and far more consequential. We're at the end of an 80-year debt supercycle. And if you don't understand what that means, you're about to get a very expensive education. In 1944, while World War II was still raging, economists and policymakers gathered in Bretton Woods, New Hampshire, to redesign the global financial system. What they created was a framework that would enable 80 years of unprecedented debt accumulation. Governments borrowed, corporations borrowed, households borrowed. And the system was designed to make that borrowing grow exponentially. For 8 decades, this worked. But every cycle has an end. And right now, we're watching the end play out in real time. This isn't a prediction. This isn't doom-mongering. This is an examination of what debt supercycles actually are, how they've ended in the past, and what the evidence tells us about where we are today. Let me show you why the next 5 years will look nothing like the last 50. Before we can understand where we're going, we need to understand what a debt supercycle actually is. A debt supercycle is a multi-generational period where debt grows faster than the economy, not for a few years, not for a decade, for generations. Think of it like this. In a normal economic cycle, debt rises during expansions and falls during recessions. Businesses borrow to grow, then pay down debt when times get tough. Households take on mortgages, then gradually reduce their debt burden. It's a cycle that completes every 7 to 10 years. A debt supercycle is different. It's when the total debt in an economy, government, corporate, household grows continuously for decades, regardless of whether you're in a boom or a recession. The debt never fully gets paid down. It just keeps growing faster than GDP, faster than incomes, faster than the economy's ability to service it. The key characteristic of a debt supercycle is that each downturn is met not with debt reduction, but with even more borrowing to prevent the pain of deleveraging. Every recession is solved by adding more debt. Eventually, you reach a point where the economy can't support additional borrowing. Interest payments become too large. The productivity gains from new debt turn negative. You're borrowing just to service existing debt. That's the end of the supercycle. The last debt supercycle ended in the 1940s. Let's look at what that actually meant. The previous supercycle began in the 1870s after the US Civil War and ran through World War II. During those 70 years, debt accumulated across the developed world. Governments borrowed to fund infrastructure and wars. The gold standard was abandoned and reinstated multiple times. By the 1930s, debt levels had become unsustainable. The Great Depression was, in part, a debt crisis. When the stock market crashed in 1929, it triggered a cascade of defaults. Banks failed because borrowers couldn't repay loans. Without banks, businesses couldn't get credit. Without credit, they couldn't operate. The economy spiraled downward. The US government's debt-to-GDP ratio was about 40% in 1929. By 1946, it had reached 119%. How? World War II. The government borrowed massive amounts to fund the war effort. But here's what's important. The debt wasn't paid down through austerity or spending cuts. It was reduced through a combination of financial repression and economic growth. Financial repression means keeping interest rates below the rate of inflation. If you're earning 2% on your government bonds, but inflation is 4%, the real value of that debt is declining by 2% per year. The government is effectively inflating away its debt burden. This was combined with strict capital controls, fixed exchange rates under Bretton Woods, and regulations that force banks and pension funds to hold government bonds at the low market rates. It worked. By 1980, US debt to GDP had fallen to 30%. But this took 35 years of financial repression and an economy that was growing robustly because America was the dominant global manufacturer. The important point is this. The last debt supercycle didn't end with everyone paying back what they owed. It ended with a reset of the entire financial system and decades of carefully managed inflation that eroded the real value of debt. The debt supercycle we're living through began in 1945 with the Bretton Woods system. Under Bretton Woods, the US dollar became the world's reserve currency, backed by gold at $35 per ounce. This created enormous demand for dollars and allowed the United States to borrow at exceptionally low rates. For the first 25 years, 1945 to 1970, debt levels were relatively manageable. The US debt to GDP ratio declined from 119% to about 35%. Corporate and household debt were moderate. The system seemed stable. Then came the 1970s. The United States was fighting the Vietnam War and funding Great Society programs. The government was spending more than it took in. Foreign governments, particularly France, started demanding gold in exchange for their dollars. The US gold reserves were draining. In 1971, President Nixon closed the gold window. The dollar became a pure fiat currency, backed by nothing except the government's promise to pay. This was the crucial turning point. Without gold backing, there was no constraint on money creation. Governments could borrow without limit. Central banks could print without limit, and they did. From 1971 to today, we've seen 50-plus years of accelerating debt accumulation. U.S. federal debt went from $400 billion in 1971 to $36 trillion today. That's a 90-fold increase. Corporate debt went from $500 billion to over $11 trillion. Household debt went from $500 billion to over $17 trillion. Total U.S. debt is now approximately $100 trillion, or about 350% of GDP. This isn't unique to the United States. Japan's government debt is 264% of GDP. China's total debt, including corporate and local government, exceeds 300% of GDP. Europe's combined debt levels are similarly extreme. Globally, total debt government, corporate, household is approximately $307 trillion. That's 336% of global GDP. To put this in perspective, in 1950, global debt was about 100% of GDP. We've more than tripled that ratio in 75 years. So why is the cycle ending now? What's different about 2025 compared to 2015 or 2005? There are three fundamental reasons. First, interest rates have risen and will likely stay elevated. For 40 years, from 1981 to 2021, interest rates fell steadily. The 10-year U.S. Treasury yield peaked at 15.8% in 1981 and bottomed at 0.5% in 2020, falling. Interest rates made debt cheaper to service. Governments and corporations could borrow more because the cost of servicing that debt kept declining. That era is over. The Federal Reserve raised rates from near zero to over 5% in just 18 months. Even if rates come down, they're unlikely to return to the near zero levels of the 2010s. Why? Because central banks now understand that keeping rates too low for too long creates asset bubbles and inflation. Higher interest rates mean higher debt service costs. The U.S. government now pays over $1.1 trillion per year just in interest. That's more than defense spending. It's the fastest growing part of the federal budget. Within a few years, interest payments will be the single largest expense, larger than Social Security or Medicare. When interest payments consume an increasing share of government revenue, there's less available for everything else. This constrains economic growth and makes it harder to manage the debt. Second, the demographic structure has shifted. Debt supercycles depend on a growing, productive workforce. You need more workers tomorrow than today to generate the tax revenue and economic growth necessary to service expanding debt. The developed world has aged dramatically. In 1950, the median age in the US was 30. Today it's 38. In Japan, it's 49. In Germany, it's 47. Italy, 48. China is aging faster than anywhere on Earth. Their working age population peaked in 2015 and is now declining. An aging population means fewer workers supporting more retirees. It means higher healthcare and pension costs. It means slower economic growth because there are fewer people in their productive prime years. Japan is the clearest example. They've been dealing with this demographic shift for 30 years. Their debt has grown to 264% of GDP. They've had near zero interest rates for decades, and their economy has barely grown. This is the demographic trap, and the West is entering it now. Third, the productivity gains from additional debt have turned negative. In the early stages of a debt supercycle, borrowing is productive. A company borrows to build a factory, which produces goods and generates profits. A government borrows to build infrastructure, which facilitates commerce and boosts productivity. A household borrows to buy a home, which provides shelter and builds equity. But as debt levels rise, the quality of borrowing deteriorates. Companies borrow not to invest in productive capacity, but to buy back their own stock. Governments borrow not to build infrastructure, but to fund current spending and pay interest on existing debt. Households borrow not to buy homes, but to cover everyday expenses on credit cards. This is diminishing returns on debt. In the 1960s, every dollar of new debt generated about 70 cents of GDP growth. Today, each new dollar of debt generates less than 40 cents of GDP growth. In some countries, like Japan, additional debt produces virtually no growth at all. When debt stops being productive, the only reason to continue borrowing is to prevent immediate collapse. You're not investing in the future. You're just delaying the reckoning. So if the supercycle is ending, what comes next? History and economics give us three possible paths. Let's examine each one. Path 1. Inflation and financial repression. This is what happened after the 1940s supercycle. Governments keep interest rates below inflation, eroding the real value of debt over time. If inflation runs at 4%, but government bonds pay 2%, the real value of that debt shrinks by 2% annually. Over 20 years, you've cut the real debt burden nearly in half without ever making a payment beyond the interest. The problem is that this requires public acceptance of reduced living standards. Inflation erodes wages. Savings lose purchasing power. Retirees on fixed incomes suffer. This creates political pressure that's difficult to manage in democracies. We saw a preview of this in 2021 to 2023. Inflation spiked to 9%, the highest in 40 years. The political backlash was swift and fierce. Elections were lost over inflation concerns. Central banks were forced to raise rates aggressively, even at the risk of causing recession. Could governments pursue sustained financial repression for a decade or more? Possibly, but it would require a level of political will and public tolerance that seems unlikely in today's environment. The second path is debt default. Governments, corporations, or both simply stop paying. This can be explicit, we cannot pay, we are defaulting, or implicit through currency devaluation and inflation. Either way, creditors take losses. History is full of sovereign debt defaults. Argentina has defaulted 9 times. Greece defaulted in 2012. Russia defaulted in 1998. It's not unprecedented. The challenge with defaults is contagion. In our interconnected financial system, one country's default creates losses for banks in other countries. Those banks then face solvency questions. Credit markets freeze. International trade contracts because nobody trusts counterparties. A default by a major economy, Japan, the US, or a large European nation, would trigger a global financial crisis that would make 2008 look manageable. This is unlikely to be a chosen path. It's more likely to be forced upon countries that lose market confidence and can no longer borrow at sustainable rates. The third path is painful, deleveraging through reduced spending and slow economic growth. Governments cut spending, raise taxes, and prioritize debt reduction. Households and corporations do the same. Everyone tries to save more and spend less. The problem is the paradox of thrift. If everyone saves simultaneously, aggregate demand collapses. Businesses see revenue decline, so they lay off workers. Unemployment rises. Tax revenue falls. Budget deficits get worse, not better. This is what happened in Europe during the sovereign debt crisis of 2010 to 2015. Countries like Greece, Spain, and Portugal implemented harsh austerity measures. The result was double-digit unemployment, social unrest, political upheaval, and nearly a decade of lost economic growth. Austerity works in theory, but is incredibly difficult to sustain politically. People don't vote for politicians who cut their benefits and raise their taxes. Eventually, the political pressure becomes unbearable and policy shifts. So which path are we on? The evidence suggests we're heading towards some combination of all three, but with inflation and financial repression being the most likely dominant outcome. Here's why. Central banks have already shown they'll choose inflation over deflation. When COVID hit in 2020, governments didn't hesitate. They printed trillions. They mailed checks directly to citizens. They bought bonds, corporate debt, even junk bonds. The message was clear: we will not allow deflation and debt defaults. The inflation that followed 9% in the US, double digits in Europe, was the consequence. And while central banks raised rates to combat it, they didn't raise them high enough to truly crush inflation the way Paul Volcker did in the 1980s when rates hit 20%. Why? Because that would cause immediate defaults and a depression. We're also seeing early signs of financial repression. Governments are implementing policies that subtly force investors into government bonds. Bank regulations require banks to hold more safe assets, which means government bonds. Pension funds are restricted in what they can invest in, steering them toward government debt. Japan has been doing this for 30 years. They keep rates near zero, forcing savers into government bonds. The Bank of Japan owns nearly 50% of all Japanese government bonds. They're effectively monetizing the debt. The European Central Bank is doing similar things. They've bought trillions in government bonds from member states. They're the buyer of last resort. The Federal Reserve expanded its balance sheet from $800 billion in 2008 to over $9 trillion during COVID. They've reduced it slightly, but it's still above $7 trillion. They're not returning to the pre-2008 world. This is the new normal. Central banks managing government debt burdens by keeping rates relatively low and buying bonds when necessary. If we're at the end of an 80-year debt supercycle, and if the most likely path forward is inflation and financial repression, what does that mean practically? First, expect lower real returns on traditional safe assets. If governments pursue financial repression, bonds and savings accounts will deliberately pay less than inflation. Your purchasing power will erode slowly but steadily. This has already been true for years. From 2010 to 2020, if you held cash or government bonds, you made little to nothing in real terms after accounting for inflation. Second, expect higher volatility. The transition from one supercycle to the next isn't smooth. There will be market crashes, currency crises, and financial accidents. 2008 was one. We'll likely see more. Volatility creates both danger and opportunity. For those with cash and patience, market crashes present buying opportunities. For those heavily leveraged, crashes are devastating. Third, expect political instability. Economic transitions of this magnitude always create political upheaval. People lose faith in institutions. Populist movements gain power. Scapegoating increases. We're already seeing this. The rise of populism on both left and right across the developed world is directly connected to economic stagnation and the sense that the system is rigged. Fourth, expect the rules to change. When supercycles end, governments rewrite the rules. Capital controls might be implemented. Wealth taxes might be introduced. Currency regimes might change. Regulations on banking and finance will tighten. After the last supercycle ended, we got Bretton Woods, strict financial regulation, high tax rates on the wealthy, and capital controls. Similar changes are likely this time. While we're at the end of an 80-year supercycle, this doesn't mean the world is ending. Debt supercycles have ended before. The 1870 to 1945 cycle ended with World War II and financial repression. The economy recovered. Living standards eventually improved. A new cycle began. The 1790 to 1870 cycle ended with various financial crises and ultimately the Civil War in the United States. The economy recovered. Progress continued. What changes is the distribution of winners and losers. Savers get hurt by inflation. Debtors benefit. Asset holders might do well if they own the right assets. Workers might struggle if real wages decline. The key is understanding where we are in the cycle and adjusting accordingly. Those who positioned correctly at the end of the last supercycle buying stocks in the late 1940s, buying real estate, investing in productive assets, did extraordinarily well over the next 40 years. Those who held cash and bonds saw their wealth eroded by inflation. In conclusion, the debt supercycle that began in 1945 is ending. The evidence is clear. Interest rates have risen structurally, demographics have shifted unfavorably, and the productivity of additional debt has turned negative. This hasn't happened in 80 years. The last time we went through this transition, it required World War II, financial repression, and 35 years of carefully managed inflation to reset the system. This time will be different in the details, but similar in the broad strokes. Governments will choose inflation over deflation. Central banks will keep interest rates below where markets would naturally set them. Savers will earn negative real returns. The value of debt will be eroded over time. This isn't a conspiracy. It's just the logical conclusion of a system that has borrowed beyond its capacity to repay through normal means. The good news is that transitions between supercycles, while painful, eventually give way to new periods of growth and opportunity. The post-war era from 1945 to 1970 was one of the greatest periods of prosperity in human history, precisely because the previous debt overhang had been cleared. We're likely heading into a decade or more of adjustment. It won't be easy. But understanding what is happening and why puts you ahead of the vast majority who don't see the pattern. The debt supercycle is ending. This hasn't happened in 80 years, and the next 5 years will look nothing like the last 50. If this changed how you think about the economy and where we're heading, there's more to explore. Because understanding these long-term cycles is the key to navigating what comes next.